Do you want to know the truth about wealthy people? They're not trading stocks. And they're not YOLOing into meme stocks either. Many of them are doing something boring. But sometimes boring is where the money is. I'm talking about index funds. In this video, I want to show you the boring way to build wealth using the same strategy that many rich people do by going over three things. Number one, I want to explain what index investing is. Number two, I want to show you the difference between an ETF, a mutual fund, and an index fund and how you can use these things to, number three, win and build wealth for yourself. So let's not waste any time and let's get started. When most people think about investing in the stock market, there are two questions that come to mind. Number one, what stock do I buy? Number two, when do I buy that stock? So you're thinking, how do I find the next Amazon? And now you might go out and buy a lot of the Amazon stock today because you think that Amazon is going to take over the world, and you take on a lot of risk. If Amazon does succeed and they grow big, you could see your stock price rally and you could get rich. But there's risk because if Amazon does something wrong, they get involved in a bunch of lawsuits and then they start not innovating, they have a bad CEO, they start to manage their cash badly, and then they go bankrupt, well now you lose everything and now you did not build that wealth and you also lost all the money that you invested. That's the risk of picking individual companies, not to mention if you're trying to find an individual stock to buy, you also have to know how to value the stock. You have to understand how to research the financials. You have to know how to study the company. And most people don't want to do that and don't know how to do that. This is where the alternative is to invest into a group of companies called an index. Now, instead of me investing my money into this one stock, I am buying this basket. I buy money into this fund, and this fund might have shares of Amazon, McDonald's, Nvidia, Tesla, Apple, Coca-Cola, and hundreds of other companies to give me diversification. Now I don't have to go out and find each one of these companies. I don't have to research any of the companies. I don't have to keep up with the financials. I just find the right fund to invest in, and I keep investing in it because now if Amazon were to go bankrupt, Amazon would be kicked out of the fund and replaced with another stock, and it's passive on my end, so I don't have to do anything. I don't have to worry about what's happening in the markets. I just keep investing money into this fund because this fund is there to find me the best companies to invest in. And you might say, well, Jaspreet, Amazon's not going to go bankrupt, right? I mean, that's not possible. Well, that's what people said about Sears as well. Sears was the largest retailer in the world, and then they went bankrupt. That's why investing in a fund is an easier way to get started. I'll show you specific funds that you can consider investing in, but not all funds are made the same, which is why I want to discuss ETFs, mutual funds, and index funds. I know this can sound very complicated, but if you stick with me, it'll all make sense. So let me show you what I mean. Index funds, ETFs, and mutual funds are three different types of baskets of stocks that you can invest in. They're all very similar, but they have their nuances, and this might be one of the most valuable charts for you to understand when it comes to understanding investing in these funds. So let's break it down. Index funds are generally passively managed. That means they're generally managed by an algorithm, not a human. Why does that matter? Because when an index fund is managed by an algorithm, your fees are generally lower because you have to pay a fee when you invest your money through a fund. You're paying a fund manager. But when you're paying an algorithm, that fund management fee is generally very low. And with an index fund, you can generally only trade in and out of these funds one time a day. It's not like a stock which you can buy and sell hundreds of times a day. An index fund you can generally only trade in and out once, and they generally do have a minimum for you to invest. Sometimes you have to invest a minimum of $500 to invest into an index fund, sometimes $1,000, sometimes a few $1,000s, depending on the fund. Let's compare this to a mutual fund. Mutual funds are generally actively managed, not passively managed, which means you have to pay an expensive money manager to pick the best stocks for that fund. Is that good or bad? Well, the goal is to have a money manager who can find better stocks to outperform the general market, but that doesn't always happen. Now, because you're paying for an active money manager, you're also going to have higher fees. This is what makes it more difficult to become more profitable with a mutual fund. Not always, but many times it becomes more difficult to become more profitable because you also have to pay these higher fees through a mutual fund to pay for that money manager to manage a fund. And just like an index fund, you can generally only trade in and out of your mutual fund one time a day. And yes, there are also generally minimums when you invest your money into a mutual fund, because generally you'll have to invest at least a few $100s, if not a few $1,000s, to get exposure to a mutual fund. Let's compare that to an ETF. An ETF stands for an exchange traded fund. This is kind of like a hybrid between index funds and mutual funds because this can be passively or actively managed. because there are many different types of ETFs out there. Then when we look at the fees, it could be low or high depending on the management of the ETF. Passively managed ETFs generally have lower fees. Actively managed ETFs generally have higher fees. But then when you look at trading of ETFs, you can buy and sell an ETF an unlimited number of times a day because an ETF trades just like any other stock. You can open up your stock brokerage app, whatever you use, and generally buy and sell an ETF like you would any other stock ticker. So you find the ticker symbol for an ETF and then you can buy and sell it just like any other stock. And there are generally no minimums when it comes to buying ETFs minus whatever the cost of the ETF is. So if an ETF is trading for $100 a share, you generally only need $100 to buy that ETF, but now with many brokerages, you don't even need the full $100. You can buy fractional shares of an ETF, so there are generally no minimums when you invest your money through an ETF. So which one's the best one for you? Well, it depends. It depends on what your goals are, depends on what brokerage you're using, but for the purposes of this video, I'm gonna talk about ETFs because they are the easiest to access. Now, I also wanna remind you that if you wanna stay up to date on the top financial news stories, so you know what's happening in the financial markets, my team at Briefs Media publishes a free daily newsletter called Market Briefs, where we break down what's happening in things like the economy, the stock market, the housing market, the crypto market, and the global economy into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that read Market Briefs every day. Plus, when you join Market Briefs now, you'll also get access to a free investing masterclass just for joining. It's completely free, so if you want to join Market Briefs, I got the link for you to join down in the description below. Now let's get into the really fun stuff, which is how do you actually win and find your investment opportunities as an index investor. And when I talk about indexes here, I mean specifically a basket of stocks. Let me show you exactly what I mean. Let's start as broad as possible. If you wanted to invest into a broad basket of stocks, here are a few options. Now, a quick reminder, I'm not a financial advisor. I'm just a random guy on YouTube. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Here are a few examples. Number one, let's say you want to invest into the total stock market. There is an ETF, a fund called VTI. This is a ticker symbol that will give you exposure to the total stock market. VTI is a fund created by Vanguard that gives you exposure to the United States total stock market. But if you wanted to get a little bit more granular, the next option might be investing your money into the S&P 500. The S&P 500 is a basket of the 500 largest companies in the stock market. Here are a couple examples. VOO and SPY. VOO is created by a company called Vanguard. SPY is created by a company called Spider. By the way, Spider is SPDR, pronounced Spider. VOO is an ETF that I'm personally invested in, but if you invest in either one of these ETFs, you get exposure to the 500 largest companies in the stock market. Then we have the Dow Jones. The Dow Jones is a basket of 30 large companies that make up America. This is one of the most prominent and well-known indexes out there because it's been around for more than 100 years, and this is giving exposure to 30 broad companies. And there's an ETF called DIA that will give you exposure to the Dow Jones. And then we have the NASDAQ. The NASDAQ is a group of the 100 largest non-financial companies in the stock market, and many of these companies just happen to be technology-based. There's an ETF called QQQ that will give you exposure to the NASDAQ. So if we put this all together, these are all ETFs, funds, that give you exposure to a basket of companies. The basket of companies is either the total stock market, the S&P 500, the Dow Jones Industrial Average, or the NASDAQ. Many of these ETFs are passively managed, meaning they're managed by an algorithm. For example, in the S&P 500, there's an algorithm created by Vanguard, created by Spider, that knows which companies are the 500 largest companies. If one of the companies, say Amazon, starts to do very bad and it's no longer a part of the S&P 500, well then, Vanguard or Spider will kick that company out and replace it with another company. And because it's an algorithm, it's passively managed, so your fees are generally lower. Now let's go a little bit more narrow to industry-specific ETFs. Let's start by talking about technology. Let's say you only want to invest in tech stocks, but you don't know which tech stock to invest in. Well, there are ETFs for that. For example, there's an ETF called VGT, which is the Vanguard Technology, IT Technology ETF. And then you have an ETF called XLK, which is the Spider SPDR, which is the United States Technology ETF. Both of these ETFs give you exposure more directly just into the technology sector. Or maybe instead of technology, you want to take a look at healthcare because you believe that that's going to be a growing industry in the future. Well, there are ETFs for that as well. For example, XLV. This is an ETF created by Spider SPDR, which gives the exposure to the healthcare sector. Likewise, another one is VHT. This is created by Vanguard. This gives you exposure to healthcare related companies without having to go out and find the right company. And then of course we have real estate. Now instead of you going out and buying a property yourself, you're investing in the companies that are investing in real estate. And a couple examples here are VNQ, another Vanguard ETF that gives you exposure to real estate investment trusts, REITs, and SCHH, a fund created by Charles Schwab, which gives you exposure to United States real estate companies. And then we can take it one more layer deeper by looking for more specific niche ETFs. So we started here very broad, giving you exposure to the broad economy. Then we went one layer deeper, talking about specific industries, specific sectors. Now we can take it even deeper by looking at more niche specific ETFs. For example, there are ETFs that give you exposure to genomics and gene editing. If you believe that genomics and gene editing is going to be a big industry in the future, well then you can look for funds in that space as opposed to find the perfect company. One example is ARKG. This is created by ARK, led by Kathy Wood. Or maybe you're a big believer in robotics and AI. Well, there's ETFs like BOTZ, bots, that give you exposure to those specific companies. Or maybe you believe that there's a big opportunity to invest in companies that provide services for people that become older because you know that baby boomers are getting older and this is going to create some sort of investment opportunity. Well, there are funds for that as well. There are funds like OLD, old, that give you exposure to companies that are servicing older people and the aging population. So now that you understand that, let's talk about how do you actually win by investing in these types of indexes. And when I say index, I mean a basket of stocks, not specifically an index fund by itself. The way that you win, especially when we talk about the broad ETFs or the broad funds, is through a strategy I call ABB, which stands for always be buying. This is very similar to, it's actually the same as what many people call DCA, dollar cost averaging. I just like ABB because it speaks pretty simply to somebody like me because it tells me exactly what to do. The way you win is to always be buying. This is what I do myself. Now again, I don't recommend what I do to anybody else, but I have a system where every Wednesday, money leaves my checkings account and is automatically invested into my portfolio of funds. Why Wednesday? Because Wednesday is in the middle of the week. There's no secret science, there's no secret reason why, it's just the middle of the week. Every Wednesday, money is pulled out of my checkings account and invested into my portfolio of ETFs. I invest in the S&P 500. I have a lot of dividend-paying funds, and then I have some innovation funds, and then some international funds. But that's where every Wednesday, money is automatically invested into these funds, and it happens no matter what, whether it's a Republican in office or Democrat in office, whether it's raining or sunning, whether it's a recession or an economic boom, whether markets are crashing or whether markets are booming. No matter what, this will keep happening. In fact, the only time I really change this is when we see a market downturn. That's when I will invest a little bit more aggressively. But besides that, I just keep investing. I stick with it because if you have a long-term horizon, we're talking about years, generally a decade plus, this has been a proven strategy to win if you are investing in good funds. For example, if you're investing in the American economy, this has been proven. It has proven the test of time. And chances are, if you continue to do that for the next 10, 20, or 30 years, you will be able to build wealth for yourself as well. And again, if you want some more resources, Market Briefs is a free newsletter. And when you join, you'll also get access to a free investing masterclass as well. This is how the majority of Americans statistically manage their finances. Let's assume that you make, as a household, $60,000 a year, which is $5,000 a month. Now, who's the first person that you're going to pay? It's not Chipotle and it's not Amazon. It's the government. Because if you're working a job...